Where do we start with all the moves that we're seeing today? I'd like to get your view on the rand. We're at session lows, 6.92 on the dollar rand, and we're at about 9.51 on euro rand. So still tracking slightly weaker against the euro, but this dollar rand is really hitting headlines on a day-to-day basis now.
Yeah, well, I think the story is not the rand, it's more a dollar story. And clearly what's happening there is that international investors are getting worried. Now, I'm trying to figure out what they're getting worried about. Are they
the
getting
quantitative
worried?
easing?
Yes, of course, but what are they getting worried about? The point I'm trying to make, are they getting worried about possible inflationary pressures going forward? Because we don't see inflation in the United States. But
well, comments about potential deflation now coming out of the United States.
That's the point. So why is the dollar really under so much pressure at the moment? I think there's just a lot of uncertainty, and I think that's the reason why the gold price is going up. The gold price is currently at 13.20, close to 13.20, and again, that's more of a dollar story. And clearly what is happening is that international investors are looking for places where they can, get a little bit of yield, and a place where they can get yield, of course, in the South African bond market. It is a highly liquid, a very sophisticated, a well-regulated market, and obviously, if you want to pick up a couple of points, you come to South Africa. What I'm a little bit concerned about, we have this current account deficit. We need all this capital to fund the current account deficit, and by the way, the trade numbers were not that good that were released this week. But we've got this current account deficit, we need the money coming in, but the money is going, of course we need the money, but unfortunately that sort of money is not going to FDI, it's not going to factories, it's going to the bond market, it's going to the equity market, and I'm getting a little bit concerned about that.
When you touch on those trade numbers, exports were disappointing in this set.
Yeah, it was certainly disappointing, a deficit of close to 5 billion rand. We've seen deficits of 8 billion rand in the past, so 5 billion rand deficit is quite a large one. We in fact expected a surplus. But the numbers are very, very volatile. Let's just accept those on a monthly basis. It's much better to rather look at a sort of a rolling 3 months kind of number. And apart from that, we have seen that the Reserve Bank's quarterly deficit, or the quarterly bulletin, reported the deficit on the current account much better than what we have expected. But still, I expect the current account deficit to widen a little bit as we go on during the year.
We've also seen inflation data out on the local front this week. We had CPI coming out at 3.5%, better than expected. PPI coming out at 7.8%, worse than expected. But again, how much cognizance do we take of PPI?
Well, PPI is theoretically, at least, and always in practice it doesn't work like this, but theoretically PPI is supposed to lead to PPI. And also keep in mind, or the CPI. Keep in mind that PPI is mostly, well, consists only of goods. There are no services in the PPI number. And goods and services tend to be much more stable, the prices of goods, while PPI only consists of goods, and that tend to be much more volatile. And of course, things like, for example, the increase in certain commodity prices will add much quicker to the PPI basket, and eventually that will be filtered through or passed on to the consumers eventually. So what the PPI is telling us already, and this is pure theory, is that eventually those sort of price increases will be passed on to us, the consumers, and eventually we should see CPI also going up. At the moment, CPI is certainly not a problem. Of course, there are two main factors. The one is that demand in the economy remains quite muted. We've seen the credit numbers, for instance, although there's a bit of a tick up, but it's still on the low side. And of course, the very strong rand. The rand, we've just had a reduction, well, actually a bit of an increase, but the increase in the petrol price was mostly because of the increase in the retail margin. If it hasn't been for the retail margin increase, we would have had a reduction in the petrol price. So what I'm trying to make is that, what I'm trying to say, the rand and very low or weak demand in the economy is certainly keeping a lid on inflation.
The market didn't like the news today around the local PMI, which came in at 48.4, below 50, and now we saw that rally above 50 in August, but now we're pulling back, and it doesn't augur well for the rest of the year.
I've got this sense that it's not only the South African economy, but globally, I've got the sense that the authorities, the fiscal authorities and the monetary authorities really did whatever they could to support, or just about everything they could to support their economies, and locally as well. We've seen things like monetary policy being relaxed quite significantly. On the fiscal side, we've got a huge fiscal deficit at the moment. So the authorities are doing whatever they could the past, say, 2 years or so. And the markets reacted positively to that. Now we ran out of ammunition. The Americans are talking about further quantitative easing.
QE2, as
it means we print dollars, and that's, by the way, why the dollar is under pressure. But I've got the sense that the markets are thinking that the authorities, they've done as much as they possibly could. Now we're back to reality. Now it's back to the real world, and the authorities really do not have that much ammunition left. Now it's left to the real economy to pull the world out of the bit of a difficult time.
And is that possible? Can the real economy call the world out?
We've got two worlds here. We've got two worlds. We've got the West and the rest. Now the West, and included in the West, of course, is Japan, and Japan is down and dead in the water as well. The rest are doing quite well. The rest, of course, are the Indians of this world, the Chinese, South America, even the old Soviet Union, Africa, and of course South Africa. Those are the economies.
Clearly a tale of two worlds, developed versus the emerging.
And the rich world, America is not going to grow, and America is not going to grow for many, many years to come. And we can see that in the currency. But so coming back to the PMI, I've got the sense that the world investors and the world economic agents are getting, they realize they have to stand on their own feet. They can't look at the authorities to boost the economies. And quite frankly, they've run out of ammunition. You can't reduce interest rates below zero. You can print so much dollars, you can run such huge fiscal deficits, and not more.
Just touch on, we were speaking about the dollar rand earlier, and you said that there's this potential risk of a sharp correction in the currency.
Well, we've seen about 100 billion odd, pretty soon we will be talking about real money, 100 billion coming from abroad into South Africa. Now, what I am concerned about, and I don't think this is going to happen soon, because our yields on our bond market, of course, is quite attractive still. I think the yields or the returns that you can get on our equity market is quite attractive still. So I think South Africa is a very attractive investment destination still. But we do know international crises happen every now and again. If something happens, if there's another, I don't think this will happen. I can't see anything, although there's a potential threat of a bit of a confrontation between the Americans and the Chinese about the currency manipulation story.
So the trade war story.
So that could be a bit of a potential threat going forward. But if there's some sort of international crisis, or maybe even a local crisis, then all this money would want to go out, all of it at once, out of the same door.
Wayne,
and it was quite small.
Wayne a moment ago saying basically you can bet your bottom dollar that if the dollar rand remains below 7 as we go into this MPC meeting in November, we will see a rate cut out of the SARB.
Well, I feel quite comfortable where short rates are now. I know I'm a bit of a hawk on short rates. Short rates in real terms run about 2.5% or so at the moment, which in the current cycle is more or less right. Actually, theoretically, again, it should be a little bit higher than that, but I'm quite comfortable with these sort of levels. If we cut rates again, I don't think the rand's going to weaken. Because theoretically, again, the rand's supposed to weaken, but we haven't seen it weaken
for the last couple of times that we've seen interest rate cuts, have we?
In fact, yes. If you look at the yield curve, now what the Reserve Bank can do, they can push down the shorter end of the yield curve, and they've been doing that. But the longer end of the yield curve, that is a market-determined interest rate. The yield on the bond market is determined by supply and demand forces, and the demand for our bonds is just strong at the moment. And even if we cut short rates, I'm afraid it's probably not going to do much. This is a dollar story, and it's a yield story. And even if you cut rates on the short end too much, I'm afraid it's not going to assist much on weakening the currency. We have also seen that the demand for credit in the economy, there's a bit of an uptick, especially on the private sector or household level. They're starting to borrow a little bit more. If we keep on pushing rates down so much, then of course households will start borrowing, and eventually the corporates will start borrowing as well, and then we may get into a situation within a couple of months that the Reserve Bank will be forced to start doing something about interest rates again. If I was the Reserve Bank, realizing that there's really just about nothing you can do in the currency in the short term, rather keep rates unchanged. Interest rates are so low, our savers are really being hammered in South Africa, people that are dependent on interest income, and we need them. We simply do not have enough savings in South Africa. If your motivation is to weaken the currency, lower short rates, I'm not sure, is the right way to go about doing this.